At least I hope so. All right, where we're getting ready to record Financial Accounting's Chapter 8 and 9. I'm just going to do Chapter 8 in this video. Chapter 8's Receivables. Okay, who else just joined us here? Okay, Oscar. Glad to see you, Oscar. I've already shared my screen, so I've got you down now. And like I said, I'll try to be aware of who's here and who's not, but we are recording right now. And so we're going to go get the coursework for Chapter 8, which I didn't get a chance to do the video for, but I am trying to do right now. Okay, so Chapter 8 is receivables. We are, like I said, we're going in depth a little bit more into assets. So this is our third more in-depth study of assets. We started with inventory, cash, and now it's receivables. Okay, now it's receivables. So, okay, I'm pretty sure I'm going to let you guys do these three here. Actually, nah, I'm just going to go through them with you. That way you catch on. Once again, receivables. Receivables is an asset. All right, so let me go get my spreadsheet. And we're going to go pretty fast. So if you've already done them or want to watch the video later, I understand. I really do. Sometimes you can only absorb so much. Okay, I'm going to go to the coursework. So once again, receivables. Receivables can be a very valuable asset. But the funny thing about receivables is you haven't received them yet, right? So they're kind of almost intangible. Do you know what I mean by intangible? It's almost like they don't exist until you actually receive them, because there is a possibility that you won't receive them, right? And then you probably won't do business with that other business again. But things happen. So there's always a chance that you won't receive a receivable. Okay, so how does accounting handle that? Well, accounting handles it with two methods. Okay, two methods. One isn't following GAAP and the other one is. Okay, so we did what we called the direct write-off method, directly writing it off. We did that in the intro problems. Okay, and I am going to have a video for those when I get finished here. So, but the main one we're going to use is called the allowance method. Okay, the allowance method. And then within the allowance method, there are two ways to calculate bad debt expense. And the other one is to calculate the allowance account balance. Okay, allowance account balance. So here we are. This is once again, percent of sales method, right? Percent of sales method means that you go calculate your bad debt expense based on a certain percentage of your sales to being uncollectible. Okay. Now, once again, a lot of this is estimates. So you don't really know what's going to happen, but you're going to try to guess based on history, based on possibly industry. I think we talked about the medical industry can only expect to receive about 50 cents of every dollar of receivables, right? So their industry is going to look way different than any other industry. Okay, so here's the main one that we really want to focus on, because this is the one GAAP prefers over everything. It's called aging, or analyzing your receivables so that you find a balance in your allowance account that is that new contra asset that we have exposed you to. So here on my screen, let's get started. 8.6. Okay, 8.6 is right here. Okay, so 8.6 is going to compare the two calculations under the allowance method. Okay, so at the end of the year, the accounts receivable has a debit balance. So if you want to follow me, I'm going to show that there's 873,000 in accounts receivable right now at the end of the year. The other thing I want to make sure you know is that they give us sales. 9,900,000 is how much in sales. So we're going to show you both of these methods under the allowance method, okay? And I know we're using the word method a lot. So there's the direct write-off method and the allowance method. The direct write-off method does not have the allowance account at all in the chart of accounts. They just write off a debt, okay? They take it out of accounts receivable and put it directly into bad debt expense. They don't mess around with this allowance. But GAAP prefers you have an allowance. The allowance is actually, one more time, is a contra asset to accounts receivable. Contra asset. We've started to see some contra assets. We're going to see another one in chapter 9. Okay, so this is that allowance for doubtful accounts. And it provides an opportunity to keep accounts receivable kind of intact while we put amounts in or out of here as we try to estimate how much our accounts receivable won't be collected. Okay, won't be collected. So I want to put in, and I've got it right here on my spreadsheet. So this is pretty much all I'm going to do for this. For this allowance, we then have two methods. Okay, two methods. 1, 2. Okay, so this is the allowance method. I know when I was learning this, I got confused about this. The allowance method means you have the allowance account in your chart of accounts and you're going to use it. So wherever this accounts receivable goes, this one's going to go all the time. Okay. And once again, this is a contra asset, which means it has a credit balance. Okay. Now, once we've decided to use the allowance method, that makes GAAP happy. Okay, GAAP, I'll put a smiley face. Yep, they like the allowance method. Then there are two methods. There are two calculation methods. Two calculations. I'm going to try not to use the word method. Under the allowance method, there are two calculations that you need to understand. One is called the percentage of sales. And I'm writing this down again. Percentage of sales means you're finding the bad debt expense. Finding bad debt expense. Okay. And then the other one is aging or analyzing the receivables. Aging the receivables. We're going to concentrate the most on this one. Okay. We're going to concentrate the most on allowance method and concentrate the most on aging the receivables, because this really gives you the best reflection of the uncollectability of your accounts. Okay. And this one really makes GAAP happy. I'll try to make a nice smiley face. Okay. Lots really makes GAAP. This is the one that GAAP prefers. Okay, is aging the receivables. All right, we do have bad debt expense. To make sure you know we have, this is a new account, and it's just an expense account like any other account. All right, all right. Uh-oh. Oh, okay. All right, let's read. It says the allowance account. Now, the allowance account normally has a credit balance. Okay, normally it does. But sometimes it has a debit balance because of activity in the account that caused it to go over to the debit side. This allowance is supposed to hold an estimate of how much we think we won't collect. Okay, so once again, our accounts receivable has 873,000 in it. It says the first one, A. Okay, the first one is A. It has a debit balance for mine of $11,800. Okay, so I'm putting this in to show you what it looks like. Okay, let me get rid of that. And then I'm going to get rid of this other stuff just so that so I don't confuse you. Okay, this A and C are using the percentage of sales method. Okay, percentage of sales method is what A is using. So they say that of the 9,900,000, that 3/4 of 1% is estimated to be bad debt. Bad debt expense is estimated to be bad debt expense. Okay, so let's put this in here. Okay, and it is 3/4 instead of 1/4. 3/4 is 0.75. Okay, so let me put 0.0075 in here. So you figure out how much bad debt expense is. And if you take 0.0075 times 9,900,000, you get 74,250. You just found bad debt expense. So here comes the entry for this. This is an adjusting entry. We're going to take 74,250 and put it in bad debt expense. And then we don't care what is sitting in here when we do percentage of sales method. Okay, it's just whatever the offset needs to be. Okay, because to be honest, when you're doing just the percent of sales method, you're not really looking at your receivables. You're just going by an industry standard or a history standard of how much is anticipated to be uncollectible. Okay, so I'm going to put this in here. It says, determine the amount of the adjusting entry to provide for doubtful accounts under each of the assumptions above. So once again, the first one was about taking 3/4 of 1% times sales and just find out what that number is. So it for me is 74,250. Okay, this is an adjusting entry, by the way. Every time we make an entry for this, is it going to be at the end of the year, right? It's going to be at the end of the year, and it's going to help us determine what the new balance will be. So now what is the balance in this account? Just so you'll know, right? We have 74,250 minus the debit balance of 11,800. Here's the new balance. Okay, and just for fun, I'm going to double check that my numbers are right. I've got a check figure sitting right here. So now this is going to be the new balance in this account. How did we get it? We use percent of sales method. Percent of sales method. Now we're going to go do C. We're going to do A and C and then B and D so that you understand we're going to be using these two calculations. So number one is the percent of sales. That's going to be A and C on this. We're in the coursework for chapter 8. I didn't get a chance to do the video, so I'm doing it now. Okay, so now let's go to let's go to C. Okay, we still have whatever balance your problem shows in accounts receivable. So now let me take out what I have here so we don't get confused. Okay, and by the way, sales, I can put over here, it's 9,900,000. Okay, 9,900,000. You can always put that in there. And I'm going to C. Okay, C says the allowance before the adjustment has a credit balance of $5,100. And then the bad debt expense is estimated to be 1/4%. Okay, so let's put in. Now you got to make sure that you follow whether it's a debit or a credit. because it will make a difference. Right now, we have $5,100 in the allowance, according to C, okay? All right, so now we're going to use that percent of sales method. The percent of sales they're saying for C in my problem is 1/4 of 1%. So 1/4 of 1% is 0.0050. I'm sorry, is 0.0025. Sorry. Okay, so now here is the bad debt expense adjustment. This is finding the adjustment. So I'm going to put the word adjustment there. Okay, and I put this is an adjusting entry here in this line. Okay, so we're doing A and C first. So if you do C, we had a credit balance of 5,100. Now we need to put in 24,750 as our adjusting entry. 24,750. Okay, 24,750. Then that's going to be a debit to bad debt expense because that's what we just found. But now there's a new balance in the allowance. The new balance in the allowance is the $5,100 that was the credit balance plus the adjusting entry we found by doing the percent of sales method. So 29,850 is what we have for B. Okay, 29,850. And once again, that was finding bad debt expense. No, they want the entry, not the balance. My mistake, 24,750. Okay, but I am showing you that now there's a new balance, but the adjusting entry was 24,750. And the new balance in the allowance account for doubtful accounts is the 5,100 plus the 24,750. Now we're ready to do aging the receivables. Same amount of accounts receivable. So I'm just going to take out what we have here and put in what they tell me for B as in boy. The allowance account before adjustment has a debit balance of $11,800. So let me put this in. And now we're going to use the aging the receivables, aging of the accounts, aging or analysis of the accounts. We're going to go to the customer ledger and we're going to put in how old all of our accounts are, how many, if there's any that are so many days past due. Okay, so what we need to do is go down here to B. Here it is, aging the receivables method. What does it do? It finds, be careful, percent of sales finds the bad debt expense, but aging the receivables, this is the one I want you to focus on the most. This finds the balance in the allowance account. Okay, this is how much the allowance account should have in it once we've made an adjusting entry. Finds the balance. I can't repeat this enough because it was really hard for me to understand this, but finds the balance in the allowance account after the adjusting entry. Okay, and once again, you think about it. Which is a better predictor of bad debt? Looking at your sales or actually now analyzing your accounts receivable and see how old each account is and really looking at that. That's your best picture. Yeah, it takes a little more work, but anyway, it takes a little more work. All right, so let me read this again. Aging the receivables method. And I want to take the word method out because it really should be write-off method and allowance method, which is what we're working in the allowance method because we have the allowance account. Then once again, when we have the allowance account, then we have two calculations. I like to say calculations now, calculations. Okay, aging the receivables calculations. It finds the allowance balance to find entry amount. Must look at allowance balance to find entry amount. So our estimated doubtful account balance for B, okay, B. My B says that my allowance should have $37,800. Okay, so you might write that down. Whatever your B says. So you say, I don't get it. Okay, here comes the visual, right? Here comes the visual. Here's what they want in this account. Okay, they want, based on aging the receivables, they want $37,800. Okay, how much is in here to begin with? Well, we have a debit for B. I have a debit balance. So I've got to make an entry here that brings this amount back over to this side and then equals this. Okay, so when you add these two numbers together, you'll get that adjusting entry. Okay, so I'm going to take the balance we want in the account plus that 11,800 debit. Okay, so I'm going to make those two add up. This is the adjusting entry. So we're going to need to make an adjusting entry here of 49,600. When we put this credit in, then we're going to put this debit in here. Okay. So I'm going to put 49,600. And then we're going to check it that it gives us the balance that we expect. What? Okay. Uh-oh. All right, I should have checked it. All right, let's go back and see what we got. Okay, let me see here. B has a debit balance of $11,800, right? Determine the amount of the adjusting entry to provide for doubtful accounts under each of the assumptions. Okay, so I thought I had it. I got the first one. All right, let me go back real quick. I'm going to go ahead and fix C first. So if we start with 11,800 and it says an aging of the accounts indicates that the estimated doubtful accounts of 37,800. Actually, I think I put this I'll go back. Let's just do B. I'll get myself confused. Anything more. Here's the adjusting entry. So if you take 49,000 and subtract, okay. Actually, we need to add. Okay, we did. All right, we added the balance that we want in the account plus the debit that's sitting there. When we put 49,600 for B, that should be right. But let me see if there's anything else I'm not looking of. Okay, they want to know there it is. Okay, there it is. Okay, so that one's okay. And here's how I check it. I do an extra check number and I just want, so if I have a credit balance of 49,600, if I subtract what the debit is there, it does match 37,800. Okay, let me go back to C. All right, let me try C one more time. Once again, we've got 9,900,000. C says that bad debt expense is 0.25%. Okay, 0.25%. 24,750. I think I just got them mixed up. Okay, so I'm going to try to put this in here. 24,750. Yes, thank goodness. Okay, so I had just put it in the wrong input screen. Okay, remember A and C are the first ones we're doing with the percent of sales, and now B and D are the allowance method with the aging the receivables calculation. All right, so now we're ready for D. Okay, we're ready for D. Same amount of accounts receivable. D says it has a credit balance of $5,100. $5,100. So how much is the entry going to be if our balance from our aging the receivables says we should have $42,300? Okay, $42,300. Here is how much this needs to be. This needs to be 42,300 minus what's already sitting here on the credit side. So we're looking at $37,200, and this is going to be D. $37,200. Okay, so let me get rid of B. And this should be D. One more time. Take the balance that we found from aging the receivables and subtract the credit balance. And once again, 37,200 is how much that entry will be. Okay, and I'll put that down here too. One more time. The estimated doubtful account balance for D is 42,300. And we needed an entry of 37,200 to bring it to that balance. Okay, bring it to the balance. Okay, moving on. Let me just double check my math. All right, let's go on to 8-9 now. Okay, now we're going to start working with this aging the receivables calculation under the allowance method. So how many different classes of timing do we have here? Now this is the balance of our receivables. So I'm going to put this amount in my receivables account. And then here's how much is not past due. Here's how much is 1 to 30 days past due, 31 to 60, 61 to 90, and anything over 90 days past due, that's the total. Now, these 1, 2, 3, 4, 5 columns should add up to the balance. Should add up to the balance. All right, so now let me go to this. This is 8-9, right? Yeah. And I think I have this down here because I think I added it at the bottom. So bear with me a second. So I do think I went over this, but I'm just trying to make sure everybody's catching it. Okay, I've got 1,141,700. So I'm going to put these numbers in that they're giving me. And if I add up these 5 numbers, those 5 numbers do add up to the total. Okay, so I just wanted to check it. This is what they call the percent of uncollectability. They have to give that to you. There's no way that you're going to know what that is. Okay, there's no way. So even the amounts that aren't past due, there's a 1% chance. I don't know what industry we're in. They don't give us any of that. They say it's their past history. They say that at least 1% is still a possibility of not being collected on anything that's not past due. What's the rule of thumb? Do either of you know? The rule of thumb is this. The longer that an account goes unpaid, the less likely you will collect it. Are you with me? So how old are these? These are past 90 days old, which means this is a receivable that has not been paid by a customer for well over 90 days, right? What's the percent of this? What's this called? Percent of uncollectability. This is the probability that we won't get it. There's a 75% chance we won't get that. So you take that number times the total for that old of a receivable and you put the number in. And then we're going to add all this up of these 5 categories, and we're now going to know what the new balance in the allowance account should be. So 1% of 615,000, 3% of, 12% of, 30% of. One other way to look at it, one other way, is if you looked at the not past due, and there's a 1% chance of not collecting it, that means there's a 99% chance you will collect it. Let's try this one. If you had 72,000 that's over 90 days old, and you have a prediction that there's a 75% chance you will not collect it, what's the percent chance you will? 25%. Okay, you flip the opposite. Okay, this So if somebody asked you, well, what's the chance of you receiving something that's 90 days or older? You say about 25%. That's not very good odds, right? Right. Much better to say 99% of something that's not past due. Okay, so I'm trying to make sure so all you gotta do now is just take each percentage and then add across to get your allowance for what the doubtful account should have in it. Okay, so I've done all that. I've got 1%, 3%, 12%, 30%, 75%. 75% uncollectability of 72,000 results in $54,000. If you add up all of these across the way, so now let me just put these in. 6150, $7,038, 14,508, 29,760, 54,000. If you add up all of those across, you'll get an allowance that should show 111,456. Now I'm going to show you what this looks like. I'm going to borrow this exercise 810. I'm just going to borrow it for a minute to show you what you're going to end up with. So here sits all of your receivables, right? Here sits this number in your accounts receivable should match that very first balance number. That's the total balance. Okay, so if I were to go across here, that's the total balance. This is not past due, not past due. This is 1 to 30 days. Oop, doesn't like that. Okay, 1 to 30 days. This is 31 to 60 days. So let me put these in just so you get the best picture you can of this. So this is 31 to 60 days. Okay. That way you can see them. So this is a much better calculation to estimate what our uncollectibles would be by aging everything. Okay. Aging everything. And then the last one is over 90 days. Over 90 days. Okay. So what this is going to look like, now I have no idea what the balance was in here before doing this aging the receivables, right? But I will say that once we age the receivables, let me highlight this. Let me highlight this in green. That's what we're trying to find. We're trying to find the amount that is the estimate for that allowance account. And let me turn these all into dollars, by the way, so we get this fixed. Okay, there it is. So when we're finished, this should show 111,456. We're probably going to have to make an entry because we don't know what the balance is. We're just trying to show that that's what they found. 11,436. I need to take out number one out of there because I got too many. Okay, just a second. Okay, darn it. I need to take a quick call, but let me put this in here. Oh, hang on a minute. Nope. Okay, so let me add this up. Let me add this up. I think I made a mistake. It's 111,000, not just 11,000. Yes, there we go. Sorry about that. There we go. I think we're right now. See, my own spreadsheet helped me figure out that I was putting in a wrong number. Okay, let's go ahead and go to this next one. Okay, this is going to take it a little further. This is taking this aging account just a little bit further now. Okay, so let me go take a quick call. I'm going to put my recording on hold a moment, if you guys don't mind. And if you guys don't mind, help me remember to turn it back on so that, okay. All right. So now we're getting ready to do another aging the receivables calculation because we have the allowance. So now let me put in the total for accounts receivable from this problem is $637,900. Okay, that's what you see right here, 637,900. When this is finished, and it's finished for us, we want 62,739 in this allowance. Okay, so we're going to put that number here because that's the balance we want it to have. Now we're going to assume that the allowance for doubtful accounts has a credit balance. It has a credit balance of 13,175. Okay, now what we need to know is how much of an adjusting entry do we need to make so that the balance in this account comes down to 62,739. So this is going to be an adjusting entry. Okay, if you've already got 13,175 as a credit, then you need the difference between what you want the balance to be and what's already there. So let me calculate this. Okay, and then I'm going to check it. That way, so once again, if I add these two together, it should get the balance of that aging receivables calculation. All right, so there, hang on, I got to put an equal sign. That's what's going on. Okay, equals plus. Yep, so there we have it. Now we need to put this adjusting entry in. Okay, adjusting entry always happens at the end of a period of time. So this is going to be at the end of November. No, hang on just a minute. Wait, this says the schedule is November 30th. Do you guys agree with that? Does this say November 30th? And then they're talking about July. They have screwed up for once. This should be, because that's not a year. If this was for a year, this would be if this was for a year, this would be July 31st. They have their months mixed up, but so I guess we're going with July. All they want to know is what's going to be this adjusting entry. I'll tell you, I'm so tired of books not matching what they say they have. I've struggled with that in my personal finance class to the point where I'm doing all the problems myself because they're not right. So whatever the entry is that you need is going to cause bad debt to go up for that amount of 49,564, 49,564. And then that allowance is going to get the offset so then the new balance in that account will be 62,739. Okay, let me make that equal that. Okay, and then like I said, they've messed up on their dates. So if this month is supposed to match this month, this should be November 30th, I guess. Because I don't even know whether it's saying a year or a month. So I'm sorry, I don't know that. Okay, so you need to put in the adjustment that it takes to make the balance in the allowance equal 62,739 or whatever your problem says. Okay, whatever your problem says. All right, we're moving on now as soon as I check my work. So the next two, we're going to focus a little bit more on this aging the receivables. Okay, that's the one we're going to focus on. So I guarantee you'll get a little problem about this on the test. Okay, looks like Chris left. Okay, so here we go. Okay, so this is going to be where am I at? 8.3a, and I don't know if I have anything to help us. 83A. Okay. Nope, I don't, but that's okay. That's okay. We'll go down here and put 83A and do what we have to. All right. So let me grab this. 83A. So this is problem 83A, to work with aging the receivables. Okay. So it looks like we've got sales for the year. Now be careful. Sales for the year. It looks like, let's read this. Okay. Call Systems Company, a telephone service and supply company, has just completed its 4th year of operations. The direct write-off method of recording bad debt expense has been used and during the entire period because of substantial increases in sales volume and the amount of the uncollectible accounts. The company is considering changing to the allowance method. So they're going to make a switch. Information is requested as to the effect that an annual provision of 1% of sales would have had on the amount of bad debt expense reported for each of the past 4 years. Oh, goodness. Okay. It is also considered desirable to know what the balance of the allowance for doubtful accounts would have been at the end of each year. The following data have been obtained from the accounts. Okay. All right. So let's see if we can't make heads or tails of this. Okay. Possibly. All right. Okay, so here is our sales. Okay, so I'm just going to start with year 1. Okay, I'm just going to start with year 1, and I'm going to put sales in. Okay, so I am, okay, all right, sales, 900,000. Okay, so you would want to write that down. And then the next one is the year of origin of accounts receivable written off as uncollectible. So the amount that they wrote off was $4,500. Okay, and they use the percent of sales method. Okay, so I'm going to put, so here is their bad debt expense. Okay, that expense actually reported, expense based on estimate, increase or decrease, and the balance of the allowance account each year. Okay, let me see if I can walk back through this and go with it this way. All right, so I'm just a T account person. I can't help it. I'm gonna go get these T accounts and bring them in for each year to try to understand what they're doing here. So I'm gonna bring this down here and put it in. See if it can't help us just a little bit. So, okay, let me see if I'm reading this here. So let me make sure the direct write-off because of substantial increase in sales volume. Yes, you can see the sales volume going up every year, right? 900,000, 1,250,000, 1,500,000, 2,200,000. Yes, we see that. And they were using a method of 1%. So that's a 1%. Okay. And so the first year, they uncollectible accounts written off was $4,500. Okay. So that matched. Okay. So so let me see here. Maybe they have, I don't know. Let me just recreate this. Let me recreate it. Okay, so they use percent of sales method, percent of sales method. Okay, so when they did so, here is bad debt expense. for year one. Okay, bad debt expense is right here. So bad debt expense is right here. So if you take 1%, and I believe that's what they use each year, 1%, we're just proving it here. We're just proving it. So 1% of 900,000. Let's see what that calculates to, just to make sure we're on the right track. $9,000. Okay, $9,000 is bad debt expense. I'm going to make sure I'm reading this right. So let me put 9,000 in and see if I'm following this. I am not. Okay. All right. Expense actually reported. All right. So information is requested as the effect that an annual provision of 1% of sales would have had on the amount of bad debt expense reported for each of the past 4 years. Okay. This is the actual write-off. Okay, this is the actual write-off. So when they wrote it off, okay. So they didn't use bad debt expense. See, they actually wrote it off. All right, so here's what happened. They wrote off, so $4,500 is what they actually wrote off. And then the year of origin of accounts receivable written off as collected. So the difference in year one is nothing. So the actual amount they wrote off year one is $4,500, I believe. Yes. Okay. But the estimate would have been, okay. And this is using so this is comparing accounting for uncollectible receivables. This is a percentage. So the estimate with 1% should be $9,000, I believe. This is using the percent of sales method. Okay, so let me put that down again. 1%. This is a new one for me as well. So 1% times sales. If we did an estimate instead of just what we directly wrote off, it should be $9,000. Okay, $9,000. Let me see if I'm right, if I'm following along. Yes. So what's the difference? The difference between the actual amount they wrote off and the new estimate is $4,500. Okay, so the balance of the allowance account at the end of the year. All right, so, okay, so they actually wrote off 4,500. And now we want to know, okay, so here's what they did. This is an actual write-off of $4,500 here. I'm going to take out the green. Okay, so they actually wrote this off. Well, when you write off bad debt, you don't have allowance. Okay, you don't have an allowance. So the end of the balance, if they suddenly decided to use the allowance, then they would have, this is the estimate of 9,000. Okay, then I think the allowance will have 9,000 in it. If my, like I said, this is kind of new to me, so I'm just kind of going by what I see here. Now, bad debt expense will have a debit balance. Okay, it'll have a debit balance. I thought they were going to compare the percent of sales method to the aging method. No, they're comparing the direct write-off method to the allowance method is what they're comparing. Okay, so there's how much bad debt expense would have been for the year. Okay, so now the allowance has 9,000 in it, I believe. Let me see if I got this right. Nope. Okay. Okay, 4,500. So what happened was, if the estimate was 9,000 and then they actually wrote off 4,500, then the new balance in this account actually is 4,500. There we go. We got it now. All right, so there it is. So we're going to pretend the estimate is up here. Okay, so I'm taking that out and putting that in. Okay, and then, all right, so then, okay, we won't worry about what's in bad debt expense. All they want to know is what's in the what's in the allowance now. So if this is the adjustment for the estimate and we actually wrote it off, so this is a write-off, because when you write it off, you actually debit this allowance, right? So it doesn't have as much in it. So now what becomes the next one? Okay, the next one, so we can fill in what was actually written off. Put 9,600. So watch. So my number 3 is 12,800. 16,550. Okay, so that's the amount they actually wrote off each year, right here. Okay, now we want to do an estimate. Okay, so this was year 1, by the way. So I'm going to copy this and do it again for year 2. Okay, so that way we don't get confused. Okay, let me do a new one now for year 2. Okay, year 2, now we've got to change the sales. Okay, the sales for year 2, 1,250,000. Okay, we want 1% of that calculated here. Okay, 1% of sales. Okay, so $12,500 is how much the estimate would be. Okay, what's the difference between those two numbers? Okay, the difference between the two. So now here comes the adjusting entry here. So this should equal what that was. Yep. And they wrote off $9,600. They wrote off $9,600. So the new balance in the allowance account, now we had a beginning balance. Now let's be careful. Let's put 4,500 up here. 4,500, this was from the previous year, right? So they switched methods. Year 1, they ended with 4,500. Okay, we've got to remember that 4,500 is sitting up there and we're making a new adjustment based on 1% of sales. Okay, so 1% is 12,500. So that amount's going in here. Okay, and then they wrote off 9,600. So here's what we need. We need to fix this formula because we need to start with the balance in the allowance and then add, okay, we want to add the new adjusting entry based on percent of sales minus the amount we actually wrote off. Okay, so I got $7,400. Let's see if we're right. That's the new balance. Okay, so and we wouldn't write this off here. So the difference between 12,000 and 9,600 is what they're wanting to know. What's the difference between 12,000? Okay, so here's what we want. Here's the estimate, and here's how much we wrote off. Okay, that's $2,900. That's the difference. Okay, $2,900 difference. There it is. I know this is tough. All right, so there's year 2. Okay, so here's year 1, year 2. I think we're getting it. Hopefully. Okay, it's just showing you the difference in using the direct write-off method. So you actually get a much better picture of your bad debt expense by using the allowance method is basically what we're saying. All right, so now we're going to take this whole thing and do it again for year 3 so we can follow it along. Okay, let me copy this. And bring it in here. This is going to be year 3 now. Okay, year 3. Now we got to put in a different amount for sales. $1,500,000 is the new sales. Okay, we got to go to the balance. The balance at the end of year 2 is 7,400. Okay, and they're writing off. Okay, so they're writing off this time in year 3, $12,800. Yep. Okay. So when we make this adjustment's going to be whatever this percentage turns out to be. Okay, 15,000. Okay, so based on the estimate, 15,000, what's the difference between 12,800 and 15,000? It's $2,200. Okay, $2,200. And the new balance in the account now is $9,600. This is that allowance. Okay, once again, they didn't use the allowance when they reported these numbers here. This is how much they're reporting. Yeah, last one now. And let's make sure that I got that right. Okay, last one. Year 4. Okay, so now let me just copy this again and bring it down so we can see it. Gotta be visual. No kidding. I'd want to prove this because it's a little complicated. All right, year 4, the new sales is 2,200,000. Okay, that means our 1% sales estimate, right? Sales estimate is 22,000. Okay, so let's see what they want. Based on the estimate, it should be 22,000. So that's going to be an increase, all right? And then year 4, we've got to begin what we ended with in year 3. So 9,600. We're going to make an adjusting entry of 22,000, and they ended up writing off 16,550. Okay, so 16,550. All right, so the difference between what they wrote off and the estimate is $5,450, and the new balance in the allowance is $15,050. Woo, that was even tough. That was tough. All right, last question. Experience during the first 4 years of operations indicated that the receivables were either collected within 2 years or had to be written off as uncollected. Does the estimate of 1% of sales appear to be reasonably close to the actual experience with uncollectible accounts originating during the first 2 years? Okay. I don't think it is, because look at the difference. You guys see the difference? So this is what we actually reported as bad debt expense, and this is what the estimate is, correct? And I'm going to say no. So I hope I'm right. I hope I'm understanding what they're saying. Uh-oh. Okay. Let me see this again. Experience during the first 4 years of operations indicated that the receivables were either collected within 2 years or had to be written off. Does the estimate of 1% of sales appear to be reasonably close to the actual experience? I guess it depends on what your idea of reasonable is. I mean, we're looking at $2,200 to $5,450 as the difference. And so I guess the answer is yes. Okay. I disagree with that, but all right. Let's do the last one now. I think this last one should be aging the receivables. Okay, let's age these receivables. All right, real quick. and see what we can do. I've highlighted all of my tabs, and I do believe I have a tab that will help us with this, as opposed to what we just did where I had to make it up as I went. Okay, so this is 2A. Okay, this is 2A, yes. So we're talking about aging the receivables. Okay, we are at the end of the year at December 31st. This is the Trophy Fish Company supplies flies and fishing gear to supporting goods stores and outfitters through the United States. Accounts receivable clerk prepared the following partially completed aging of receivables method as of the end of business on December 31st, 2004. Okay, the following counts were unintentionally omitted. Unintentionally omitted. So we've got to put these in. So the first thing we're going to do is figure out how old, okay, how old. And I'm going to need to put in a new due date chart. So hang on a minute. Okay, hang on a minute. So what you want to do, first of all, here's the cheat for your days of a month. Okay, if you're not really very good at remembering how many days are in a month, I put this chart up here, days in a given month. You got to know that. Okay, this just shouldn't be knowledge that you don't know. You should know how many days are in a given month. Okay, so let me spread this out over this. Okay, and that's what this is. So I am going to highlight this so we can remember it. All right, this is just for us to remember. Now I'm going to put down, I'm going to copy this. I'm going to copy and paste it over here in my spreadsheet. Okay, copy and paste. Let me see if my past due percentages, that's not correct either. So I'm going to need to copy two things. Okay, I'm going to need to copy two things. I'm going to copy this, and I'm going to copy this and bring it over. Bless you. So I'm going to do my my snip, not my zip, but my snip. Good grief. Okay, there it is, snipping tool. I'm going to cut this out and bring it into my spreadsheet so I don't have to constantly be looking at it. I love snip. It's awesome. I don't know if you've learned to use snip, but it sure can help. Okay, here's my accounts that I need to add to what I've got. And this is the uncollectible accounts percentage for this company. So I need another one here. I'm going to bring this in because it's a little bit different than what I had before. Copy. So if you have a chance to bring that in without, I guess I missed it. Let me try it again. Snip. I'm snipping their percent of collectability table. Okay, because it's different than the last one I used. So, and it's not the same for every company either. Not the same for every company. It's based on their history or their industry. All right. Here's what we've got. It says determine the number of days past due for each of the preceding accounts. So we've got to know how many days past due Adams, Blue Dun, Cicada, Deschutes, Green, Smith, Western, and Wolf. All right, so we're going to figure out what they are. Okay, so I'm going to put down, how many do we have? 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. I'm going to put their due date here. Okay, so you might do this on a piece of paper or in a spreadsheet like this. So I'm going to put the due date. So my first one is May 25th. Oop, May 25th. And then we're going to figure out how old that is. Okay. So I'm going to take these numbers out. Okay, so then I'm just going to put in my due dates. So my next one, and at least, okay, okay, just put them in exactly the way they have them here so you don't get it confused. So my next one is October 3rd. Okay, October 3rd. Okay, my next one is September 19th. Okay, September 19th. Okay, and then the next one is October 16th. Just got to change dates. The next one is November 12th, November 26th, December 10th, and January 11th. Okay, so December 10th, January 11th. Okay, well, the good news is we're still working with December 31. So we're going to have to figure out, okay, and they want to know number of days past due. Guess what? Your Wolf Sports hopefully is not any past due. Okay, so January, I'm gonna put 0 here. See, that's gonna already be there. So it's not past due because this is December 31st. And if something is due the next year on January 11th, it's not past due. Okay, in fact, I'll put not past due. So I'm going to put 0. There we go. That's going to be the case for your last one too, I believe. So here's what we need. We need to go back in time. Okay. We need to go back in time. So my first one, my oldest one, like I said, this is December 31st. My oldest one was May 25th. Whoa. All right. So what I want to do is put May 25th here. I'm going to subtract May 25th from the 31st. So remember, May has 31 days. I'm going to subtract 5 from it. Okay, so that makes the number of days that it's past due in May. All right, so 31 minus 25 should be 6. Okay, then now all I have to do is fill in. So it's past due 6 days in May, 30 days in June, 31 days in July, 31 days in September, 30 days in September, 31 days in October, 30 days in November, and 31 days in December. Now I have a calculation over here that's supposed to add everything up across the board here of how old something is. So this is not, if you've never done this before, it might seem a little complicated, but you should have one that was probably in May, and now it's the end of the year. So this top one should be the oldest one you have. And I'm going to put in 220 days in here. 220 days, because that we've got to age these first. We've got to age them first. Okay? All right, I'm going to go to the 19th. My second one is the 19th. That's the second oldest. All right, so I'm going to go clear over here to September, and I'm going to think about it. So if September has 30 days, we want 30 minus 19. Okay, so you always start with the month that it was due. Okay, and you'll put equals 30, or actually equals 30 minus 19. Okay, so you go to the month that it was due, you subtract the number of days, right? You start with the number of days in that month, which is 30, and I'm going to subtract 19, so I have 11. It's 11 days past due in September. It's 31, 30, and 31. Okay, so now when I go over here, it's 103 days past due. And I'm going to check my work now and make sure I'm on the right track. I got to go down. So that's my second one. Okay, we probably should have put these in order. We could have flip-flopped those, and it would have been, but I'm trying to stay in the order that they want them presented. Okay, So now in my next oldest, the third oldest is this October 30th. So you go to the month that it's due, you put in the number of days in that month, and you subtract the due date. So it's 28 days old in October, 30 days old in November, and 31 in December. Okay, so I'm trying to kind of give you an easy way to think about this. It should be 89 days past due. Okay, and then now we can go, I think, straight down the row. So now we've got one due on October 16th. So I'm going to October, and I'm putting in 31 days, which is how many days is in that month. And I'm going to subtract the 16th. So 15 plus 30 plus 31. Okay, so that adds up for me of 76 days. And once again, these were left out of the aging the receivables. So we're going to have to put them in where they go. All right, so now we're on November 12th. November 12th. If it's November 12th, if it's December 31st and something was due on November 12th, you go to the month of the due date. You start with 30 days and subtract 12. Okay, all right. All right, and then that's 31. Okay, so I'm going to go ahead and finish these out now. Okay, if it was due on November 26th, then we need 30 days minus 26, and then you add 31 to it. And then finally, something that's due on December 10th, well, it's December 31st, and if you subtract 10, you have 21. So now let me fill in the rest of these days. We got 21 days, and then my others are over here at the side. Okay, and then Wolf Sports is not past due at all. So I got 35 and 21. I got 49, 35, 21. 49, 35, 21. There we have it. Okay, let's see if we've got these. Yes, we do. Okay, so now we have these and how old they are. Now we're going to, okay, so now what's the next thing we do? So now this is aging the receivables. That's the instructions. Okay, and then we got them how past due they are. Now we need to put them where they go. The amounts, okay, the amounts of for the account that's past due. So the first one, right? The first one is the oldest. It's 220 days past due. So let me go see their categories now. Whoop, categories. I think it's going to it's going to add to that last column. Yes. Okay, it's going to add to the last column, which I think, okay, so you could put numbers in here, right? So Adams is over 120. Do we have anything more than 120? So let me move over here and look. No, we don't. So this is the only amount that you put in this column, and I'm going to move my little, no, I'm going to move my little amount so I can read it. All right, the first one is $4,800. So more than likely, Adams is hopefully your oldest as well. I'm going to put 4,800 there. All right, our next category is 91 to 120. Okay, how many do we have? 91 to 120. Okay, so I've got one. It's 103 days old. Okay, 103 days old is the third one. So that's going to be Cicada, and it's going to go here. And now let me look on my spreadsheet to remember how much Cicada, 8,600. Okay, Cicada is, and that's, okay, $8,600. Right? Now we're ready to go to 61 to 90 days past due. 61 to 90, that's going to be our second one and our fourth one. So the second one is done, a blue done. How much is it? It's 4,700. So blue done is going to get put in the third. Okay, so it's 4,700 and the fourth one is 7,000. Okay, so you need to put those in. Okay, the next category is 31 to 60. Okay, 31 to 60. So do we have any of those? 31 to 60. Yes, we have two. Okay, 31 to 60. So River Sports and Smith. Okay, how much is River Sports? Green River Sports, $3,500. Okay, $3,500. And Smith, okay, Smith is 2,200. Okay, Western, and then this one is not past due. Okay, so you can put Wolf Sports in the not past due column. Okay, not past due, 4,200. And then the $6,900, I think, is, let me go see how old it is again, because I forgot. 35 days past due. Yes, so there are all of your 8 amounts that got left off of the aging schedule. Okay, of the aging schedule, and then $6,900 goes right here. Now, we're also going to add each of these numbers to this total. Okay, so all you have to do is repeat the number that you put over to the side because it's not included in the balance. So make sure you're keying in the amount you put in over there under how many days they're past due. Green River. That would have been easier to put those in first. Sorry about that. Then we could have just used that amount by figuring out their age. All right, 6,900 and then 4,200. Now we're going to have to do some totals. Okay, we're going to have to do some totals. Okay, so this one, now we got to add what's up here to, we got to add the new number to what the subtotal is. All right, so we're going to do that. All right, let me see what I put down here. All right. Okay, I'm going to just kind of free blow this here, free form this. All right, so how many, all right, here's the balance. Okay, and then there's how old something is. I'm just going to go ahead and put these subtotals in. I'm putting the subtotals in here. Okay, my first subtotal is the balance, 1,319,300. Okay, so let me go 1 million. I got one too many zeros. Okay, now we're ready. 758,200, 299,000 is 1 to 30 days past due. 129,300 is 31 to 60 days past due. So 61 to 90 days past due is 36,900, and 91 to 120 days past due, 17,400. And then finally, the last column that's over 120 days old, 78,500. Now I'm just going to go and put in how much we have for each of these. So I'm just filling this in. Okay, and now I'm going to get a total. Okay, now I'm going to get a total, and I want that added to that subtotal. So there's the new total of accounts receivable. Okay, so now I'm going to fill in. I'm going to fill in the formula to add up everything above right there. Okay, now I'm going to put those amounts in. So I got 4,200, 6,900. Okay, up here 3,500, 2,200. I got 7,000. And then I need to go up 4,700, 8,600, and then 4,800. Okay, so those are the new totals. Okay, so we're going to key these in. And key in my totals now. Okay, so I got 1 million. Okay, got to do 1,361,200. Okay, 762,400. I'm just keying in what my spreadsheet added up. Okay, it's good to know those numbers. Okay, and then 48,600. And then the last two numbers, 26,000 and 83,300. Now we got to go to our little chart here. So I'm going to bring this down and over so you can see it. And we're going to need these numbers anyway. So I'm moving, nope, leave that one alone. Let me move this one down here. All right. So now that we know, we need our percent of uncollectability. Percent of uncollectability or uncollectible. Okay. Nothing, right? So we have 1%, 2%, 12%, 28%, 41%, and the final column has an 84% uncollectability percentage, and I want all of these to be percents. Okay, I want all of them to be percentages, so I'm going to put them in as percentages. Yep. Okay, so now I want to back it down. Nope. Okay, I've got to fill these in again. Sorry about that. Got to fill them in again. When I change it to percentage, there we go, 28, 41, 84. Okay, so now we want to do the math. Okay, we want, this is going to be the estimate of uncollectible, right? This is the estimate of uncollectible. So this is what we want in our allowance balance. Allowance balance. Allowance balance is what that's called. Allowance balance. All right, so now I'm going to do the math. So 1% or this times whatever's sitting here, okay? And then I'm going to take my formula and go across, okay? This is the magic of Excel. Awfully cool. Wish they built in Excel into this, but they didn't. All right, so over here, I'm going to turn these to dollars, okay? And get rid of the cents. Okay, now I'm going to add across how much that is. Okay, nope, I'm going to add across and add up all of those columns. And I got 124,182. So I'm going to key this in here, 124,182. Now you just need to key in your percentages. There it is. Oop, that's 1, 2, 12, oops, 12, 28, 41 and 84. Okay, 41 and 84. 41 and 84. Okay, now I can key in the amount for each one of those and see if I'm right. So though this is the schedule that we are creating to prove why we think this is a decent estimate of of the uncollectible amount of our accounts receivable. This is a much better estimate than just using percent of sales. It's not as fast, but the nice thing is most of this work that we're doing, sorry, what did I do? 1, there we go. Most of the work we're doing, software can handle it. Software can handle it. You'll just get a report that says, age my receivables. there it is. Okay, so the estimate for the allowance, right, based on this is adding up all of these amounts that we got for each column. Okay, so I'm going to put that number in here, and then I'm going to evaluate what is in the allowance. So let me scoot this over. You stay over there. Okay. All right. I've got 124,182. So here's what it's going to look like. Here's what we want. We want this to have 124,182 when we're finished. So estimate the allowance for doubtful accounts. Okay, 124,182. Okay, let me see if I've got it. I think so. Yes. But this is what we want. Now we need to read. Assume that the allowances for doubtful accounts, okay, has a debit balance of $3,500. So I'm going to make that happen. Sometimes you've got to see it. You've got to see it. So this is the balance. Let me move it down one. And I'm going to put balance before adjustment. Before adjustment. Okay. So we want it to have 124,182. We need an adjusting entry. An adjusting entry for this is going to add these two numbers together. Okay, we're going to add the two numbers together because we want the balance on the credit side. So we got to bring it back over to the credit side, which is $3,500. And then we want 124 down at the bottom. So we're going to put an entry in as a credit to allowance. And there it is. So we can make that equal that. That's fine. Okay. And then the adjustment will be a debit to bad debt expense for 127,682. So this is going to be December 31st is the date, and it's an adjusting entry, and we want a debit to bad debt expense, of 127,682. And then the allowance for doubtful accounts, which I think we've got a chart of accounts up here. Allowance for doubtful accounts. There it sits. Look at all the accounts receivable, by the way. Look at all of them. We aren't used to seeing that many. In the real world, there is no accounts receivable that represents all of them. The real world, accounts receivable has that business's name on it so that Adams doesn't run into Blue and Blue doesn't run into Cicada, right? Because you would never be able to separate them out if you lumped them all together. But we don't teach that at first. At first, we teach that accounts receivable is all one account. But I just wanted you to see that. That's the real deal. So, okay, so now we're going to use the allowance for doubtful accounts as the credit to our adjusting entry so that when we make this adjustment, our balance in our allowance account, remember, is supposed to be 124,182. Where did that come from? That came from aging those receivables up here. There it is. Aging the receivables, really taking into account all of the amounts we have, right? Is there anything else? Okay, so here's how it should roll. Let me see if I've got it right. Okay, here's what you should learn from all this. Okay, so let me show you. Allowance for doubtful accounts is a contra asset. Contra. It counters an asset. So if you don't have enough in here, if we would not have done this adjusting entry, what would it have had? Would have had a strange debit balance, which is not good. It's not the way it should be. So on the balance sheet, assuming that the adjusting entry was inadvertently omitted, that means somebody forgot to do it. It's not intentional. It's just a mistake. So on the balance sheet, if you don't have 124,182 to counter that asset, that accounts receivable is too high. It's too much in it. It's overstated by the difference, by that adjusting entry difference. Okay? All right. So the asset, accounts receivable, would be overstated by that 127,000, not the balance, but the amount we put in, 127,682, because the allowance for the doubtful accounts would be understated. It would have just had this $3,500 in it, right? By that amount. It would have been understated by the adjustment. Well, remember, so now it says, in addition, the stockholders' equity, retained earnings would be, this is bad debt expense. This was understated. Okay, bad debt expense was understated. When you have an expense that's understated, what happens to your net income? It's overstated, and this all boils down to that amount of that adjustment, okay? And so therefore, equity would have been overstated, okay? And by the amount of the adjustment, okay? There it is. I know that's kind of difficult to understand, but I've got it pictured here for you to try to help, right? Once again, if we would not have made this entry right here, this account would have had 3,500 in it, right? That would have made that accounts receivable actually go up if we would have left this balance here. And so it would have had too much in it. This allowance wouldn't have had enough in it. It needed to come back over to this side and have a balance of something. And then if we left this out, this amount of the expense would have never gotten reported, so it would have been understated. And when you understate expenses, you overstate profit. And remember, profit goes to retained earnings, so they would have been overstated. That's it. Thanks be to God. That's it for 8. I know we have 9 to do. I'm going to start on 9, okay? Because I'm going to make the video. And then if you can stay and work on it, great. If you need to go, I get it. But I'm going to stop the video now, and I will be posting this for anybody who needs to go back. Okay, Zoomers, I'm going to go ahead and do 9. If you want to stick around and listen, you can. But if you have somewhere to be, I understand. And then I will post the video for 9 as soon as I'm finished. Okay? Sorry it takes so long, but welcome to accounting. As we have 5 weeks to go. So, all right, let me stop my recording.